links that I don't need at the top of my page.
Hi, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with David Skrika, runs the website addictedtoprofits.net. And we've seen some wild gyrations in the stock market. And a lot of the, but despite the dump the other week in which the Dow fell like 1,000 points in a day, then hit it again for another hard drop, the market has come back. It's up 5 days in a row. I just saw that this is the biggest two-day gain since November of 2016. And everyone right now is very excited, very bullish. And I was just watching CNBC, and someone I saw was saying things are now going to return to normal. And what we saw was basically a computer glitch that caused the stock market to drop. And now the sky is the limit. And we can perhaps even go up, like people were saying Bitcoin was going to go up last year with the predictions of Bitcoin to 1 million. Now we can revise our stock market gains. So what are your thoughts, Dave? Are you now very bullish, or do you think this is more than just a computer glitch?
Well, I actually in January I added to shorts, but like in terms of my kind of ETF shorts, but I took some of them off on the decline and the spike and the VIX, and we're kind of waiting for a rally like we've seen. And look, what I'm just undecided about right now is, do we see a rally to new highs, or do we just, have we topped and then we kind of see this bear market rally then roll over again? And what I'm looking at is a number of different scenarios. Like if you go look at the spring or the early part of 1987, 2007, 1929, what you'll see is there's declines similar to what we just saw, like a 10% correction. And those declines are actually the warning sign of something bad happening. But after those declines, there's kind of a consolidation, and then there's a rally to new highs, and the market actually continues to blow off into the summer, then rolls over the second half of the year. And in the case of 29 and 87, it was crashes. In the case of 2007, it was this topping formation, and the decline, really bad decline, happened in 2008. So is it that, or is it something like the Nikkei? I mean, if you look at how parabolic these markets got, it is kind of similar in a way where you get this blow off into, and gold did this in 1982, you get this blow off in kind of December or January, and this is kind of the first smash lower, and then you have a rally, and this, but because it's only a correction, people still have the bull market mentality, that rally ends up being some sort of bear market rally. And then the market begins just to really roll over for the rest of the year. And that rollover would probably start in a few months' time. So that's where I am. It's hard for me to get long-term bullish here, but I would definitely think that so my question is this just the rally that gives us some kind of blow-off or top later in the year into the summer, or have we seen the highs and we roll over? But here's the interesting thing about both, if either one of those two scenarios happens. I am noticing that many stocks now are really underperforming, not acting well. And that's kind of what happened in 2007. That even though the market ended up in 2007 and the market rallied off its lows, in the summer of 2007 into the end of the year, many stocks did not act well. Many stocks were already rolling over, and there were not very many stocks going to new highs, despite that the market averages were going to new highs in October 2007. So I think now with this bust in this market and many stocks underperforming and not acting that well, we may be in the early stages of that. And just so you know, though, that doesn't have to mean there will be new highs. Like sometimes that erosion happens while the market is starting lower. Sometimes that erosion can happen as the market kind of tops.
Well, one comment I want to talk about the VIX in a minute, but about what you're speaking of is, our experience and the experience of almost everyone listening to this when it comes to bear markets in the United States are the last two, 2008, the year 2000. And both those bear markets, there's a topping process that took place over months. We've also had two corrections, or really three, since 2009. But there's two, one 2010, one 2011, which the market fell pretty hard like we saw recently, and then swung around and went up. The point of this is that I think all of us, and I've seen, I was thinking this myself, and I saw some other people make these remarks. too, that oh, we got plenty of time if things are going to roll over. And this one guy was bullish. He said, well, the market's going to go sideways like it did in 2010, 2011, then rally. And then I'm thinking, well, if we are going into bear market, we got months and months to get ready, and we can notice all these things. In 2015, we were doing that. The market had the internal erosion over the entire year, over January to July. So there's plenty of time to notice it. But what if it's not like that? If, you know, and that's the scenarios like the Nikkei scenario that you mentioned, and no one is really thinking about that and prepared for that. If that were to play out, which the market just fell here, then bounced and rolled over, no one is ready for this at all. If that were to happen,
I'll show you the Nikkei right now. You know, basically, if we were in the kind of Nikkei scenario, one of these January tops, I would say that we're a month behind them. Like they peaked at the end of 1989, so I think the last trading day of 1980 was. Yeah, I'm gonna get mine. I'm gonna get the chart too, just so I can like kind of like look at it. But anyhow, so the thing about it is, and I want to put my chart up so I can kind of like, you know, just
sure. You know, the chart's not that good anyway.
Yeah. So I'm just going to get the Nikkei from 1989 to 1990, or sorry, 1987 to 1991 here, and I'm going to put it on a linear scale so you can see the blow off and see what I'm talking about. So I'm going to do that right now. I just put that up. Okay, so here, 1 second. That's just me right now, but we're going to get this. So here's a Nikkei right here. So what you can see is we would just be kind of in this scenario here. Now, we did drop a little more off the top. The Nikkei only dropped like 6-7%. We dropped 10%, but come on, nothing's being exactly the same, right? But you can see there's this quick drop. I'm going to put it actually on a line chart so you can see it better. You don't really get the candlesticks on the older charts. Yeah, so we would be just in this kind of little bounce right here, right, where you might take back 40 to 50% of the losses, and then the next move could be a really vicious move to the downside. So that, I think you're right, is a scenario no one is looking at. And I think what scares me right now, I'm going to get the current Dow chart here, is if we go look, this is the weekly chart of the Dow here. What scares me is look at this move from November to December in the Dow, right, where it kind of goes straight up, right? That kind of reminds me of the move in, you know, the Nikkei from about October to December, where you just had this last straight up move. The Nikkei, you can see, went from 35,000 to 39,000, went up over 10, 11%, you know, 4,000 points in just a few months, and that was the final blow off. So if something like that happens, I really don't think people are ready for it, right? I think that people think they have time to get out, et cetera, and you would kind of see this watershed decline. And the thing that's worrying me right now about the market, and in the short term we could see a little bit of a bounce because it's pretty oversold, is we go look at these bonds here. This is the 10-year bond. You know, this has been relentlessly going lower. This morning we had 291 yields on the 10-year bond. This whole thing is predicated on cheap money, the ability to borrow cheap. This is the HYG, which is the, you know, the junk bonds. You know, they've bounced a bit too, but if you can see they're under their moving averages, you know, maybe we'll bounce back to these moving averages. But if these trades kind of roll over here, I would think that would be really, really negative for the market. And one of the major problems we're having is just the amount of supply of debt coming onto the market to keep these rates low. You know, because of the combination of the tax cuts bringing in less revenue, and you know, the Congress's reluctance to cut anything. Democrats don't want to cut social type spending. The Republicans don't want to cut military spending. Because of all this, you know, we're seeing the deficit blow up this year. It's going to be about $1 trillion during the top of an economic cycle. So I think that these things are really going to continue to put upward pressure on interest rates. Just simple supply demand. The amount of supply of debt you're flushing onto the market is going to put upward pressure on rates because
yeah. One of the things about all this, though, is what I've seen in commentary is a lot of people have said that the stock market, it kind of just had a malfunction, and that's the reason why it dropped. And now we're returning back to the way it was trading last year, just a couple of weeks ago. And what they say is the cause of the drop is the VIX spiking up, that there are a lot of people short the VIX, the volatility index. And this is SVXY, an ETF designed to short the VIX. And people, you can see it was at 140 and then it crashed. And one of these VIX ETFs is actually shutting down.
XIV.
Yeah, it's shutting down. And this is really what caused the market drop. And it was just a temporary glitch. And one of the funny things about this is that on one hand, was a very stupid trade because, you knew the VIX was going to go up at some point one day, even if we just had a market correction. And so it was dumb just to keep shorting it and shorting it and shorting it. Now, another funny thing about this, though, it just is despite this crash in this ETF right here and what the VIX has done and all these people getting blown up, there's an article in today's Wall Street Journal that shows that I'm trying to pull it up here.
Well, Mike, while you try to pull it up, I just like to talk about. No, this was one of the major driving trades of the market. Okay, like people were shorting volatility and going long the market in sort of pair trade, right? Because we have long, so they were basically doing a double long trade in a way instead of long short. They're shorting volatility and going long the market. Like maybe like a trade that would hedge itself is maybe you would short volatility and go short the market. So that way, when the market dropped, you would just think that volatility would drop more than the market, and that would be a way to make money. But they were kind of like, doubling up. And of course, both those trades went against them because all of a sudden, when you had to cover your volatility shorts, you also had to cover your stock longs, right? But here's what the comment I want to make is that one of the driving factors of the 2000s boom was, for example, subprime lending, right? And there were all these hedge funds that were like subprime hedge funds. They just would own subprime debt, and they were created mostly by the big banks, by Goldman Sachs or by Bear Stearns and these places. And they all blew up in March of 2007. And that was the end of the no volatility trade. Then, if you go look what was happening back then, the VIX was trading around 10 in 2006, similar how it traded around 10 last year. And so when that all blew up, people said the same thing. Oh, that's just one trade that blew up. It's just, it's just subprime lending. And the market did have a short-term bottom and then go up into new highs in the summer. But the end of that trade basically stopped one of the major catalysts for the momentum in the stock market, being short volatility, being long subprime, which was creating all these loans, which was helping the economy and the real estate boom. Well, now we've got one of the major trades being short volatility and long the market, and that one trade is gone. So we still have other things like, because of the tax cuts and because money's still relatively cheap, the buybacks, the repatriation of money, all of these things are kind of still happening. But that one aspect of one of the driving factors of this bull market, the short vol long market trade, is now done. And I think that's a major factor. And like I said, if you go look at all these bear markets, regardless of whether they start off and sell off like that, or there's a rally back to near new highs. But if you go look at 2000, you go look at 2007, like I said, 29, 87, there's a decline like that, at some point, over the first half of the year, and then the market may or may not blow off or go to new highs. But that first decline, like what happened in the spring of 29 or 87, or the March of April of 2000, those were all the warning signs that basically the big bubble trade was coming to an end. And then, whether it was a year later or 6 months later, 2 months later, there were going to be some kind of big bust in the market. So that would be my opinion on it, that this volatility trade ending is a key aspect, showing that we're probably in the end of our.
Well, what I find funny about it in this article is that, yeah, a lot of people got blown up, obviously, because of what happened. But there's people in this article they're interviewing, and I think it's a dumb trade just to begin with. But these people are talking about they're going to continue doing it. That and it says that this short VIX fund has gone from 300 million in assets a week ago. Obviously it had more than that, and it crashed 97%. But it's the people are just piling into it to do it again. It's gone from 300 million assets to 800 million. And it's just kind of crazy that people aren't deterred from doing this all over. At least some people aren't.
Well, again, I'm getting I'm going to get put on a line so we can see it better. This is a long-term chart of the VIX. It's going back 20 years. So essentially, this goes back over the last two bear markets too, the early 2000s and 2008 and 2009. And what we can see is, like, look at all these spikes in 2001 and 2002 in the VIX to 35, 40. And this is, by the way, not showing the intraday moves. This is just the closing highs, right? So what we can see over and over again in that 2000 bear market, there's numerous closes over 30, right? And if we go back, if I can go back even further, see the last two bear markets have seen this kind of low volatility range for a number of years, which gets people like complacent. Like you can see in 95, 96, the VIX is trading in the teens, and then we had a correction in 97 that kind of ended that. But what we can see here is, again, during this bear market of 2001, 02, you got numerous spikes again and again over 30, and that will wipe out these volatility funds, because these volatility funds just don't track the VIX. I think that's the real stupid thing about it. They attract complicated derivatives that base their pricing from the VIX. So they can erode like crazy. Like when we saw the XIV go down 90% in a day, right? And go from $150 to $5 in a few weeks, right? But anyhow, and go look at 06, 07, the same thing. After that crack of the market in early 07, all through 08, or all through later, the latter part of 07, 08, 09, we have these huge spikes in the VIX over and over again. So these people, the history tells us, if you go look at the mid 2000s or mid 90s, after you have this long period of volatility dry up, and then you get the first spike. And in the case of the 90s, it was 1997. In the case of 2000, it was the mid 2000s, it was 2007. That you're going to have a number of years with higher volatilities and more spikes in the VIX. So even if you're in the late 90s period and the market does go to new highs, the people doing that short VIX trade are going to get absolutely slaughtered. They think that's going to keep happening.
Yeah, it's crazy. Well, we could just look at the last bull market. I mean, they traded super low last year, but look what it did in 2010, 2011, and 14 and 15. It's going to go, it's nothing for it to go to 30 in a year. And from, when it's trading at 12 to 30, you're going to get killed. It's just a really stupid trade. But it's not just regular people doing it, but a lot of professionals. And, this article talks about the Harvard endowment was doing it. And it's just really crazy. But
I think, again, it stems back to what I'm talking about with interest rates, that everyone now just believes that these central banks can keep printing money, can keep volatility down, can keep equity bull markets going, because it's been so long. It's been 9 years, since the last bear market really ended. And, we basically, until this little correction we just had a few weeks ago, we hadn't had a correction in 2 years. And we haven't had a 15% correction since 2011, right? So that's a very, very long time, almost 7 years, to go without a 15% correction. So again, like it just, people don't really think, even after that decline, they probably think that's it. They probably think that decline is like December 2015, and there's not really going to be another major decline now for 2 or 3 years, and they can pile back into that trade.
Well, I think the weight of the evidence suggests that the average person and the professionals aren't worried about the stock market at all. The Investors Intelligence Survey barely made any change at all from where it was just a couple of weeks ago, despite the market drop. The VIX is all the way back down. It did spike up very quickly, but it's spiking down just as fast. Everyone on CNBC that I've been watching is talking about it's returning back to normal, and the market was just dropped by a computer glitch, basically. And let me show you really quickly. I got to pull this up.
Well, I want to show something.
So let me show you something real fast. Here's an article this morning that's showing that that Apex Clearing, which does huge clearing for brokers across the United States, they actually on the day of the drop saw an 84% increase in net buying, not selling, but net buying from individual investors that have robo accounts and self-directed accounts. So the retail investor was not selling during the drop, they were buying, and they have not been phased at all by what has happened. So there's no real fear in the market at all. If anything, everyone is convinced that this is a buying opportunity, just as you have kind of alluded to.
Well, like this is a chart at 28.29, and this kind of shows you what I'm talking about here. And I 1 second, I don't want that chart. I don't like when these people do a chart comparing it to like what's going on today. I just want to find okay. Like this chart here shows you, right. And what no one ever talks about with 1929 is there was actually this big consolidation, over the first half of the year. There was a huge run in 1928, kind of like last year. And then the market actually had a couple, you can see this was a sharp drop in late 1928. And this was, these are like about 10% corrections here. So it had these numerous corrections and then finally had this final blow off here. And by the way, that was kind of what happened in the spring of 29. By then, most of the retail investors were invested. The market was in the full-fledged bubble. All of that stuff was going on. And so I'm just going to turn off my Hangouts here, but or turn off that thing here. But anyhow, so we can see this here going sideways and then busting out. And this did shake some people out, but for the most part, the retail investors still thought, oh, you hold through this. And if anything, that little correction made them more aggressive. Made them go on margin more. Made them think that every dip was a buying opportunity. So that's what I'm trying to figure out here. Are we topping like the Nikkei, or are we in just kind of this range that will maybe see a false breakout and then something bad happen later on? But yeah, I definitely agree with you when you look at that as if you're a contrarian, that has to kind of scare you because I remember actually at the 2010 and 2011 bottoms, I actually was bullish because you could see fear. You could see people that were thinking, oh, it's like 2008 or 2009 all over again because it was so fresh in their memories. But now it's the opposite. Now people are aggressively buying, even though stocks are at really, really high valuations. So, I definitely think there isn't any fear on this, and people just think this is going to keep going high forever, or higher forever.
Well, we're definitely, if we're in that 1929 scenario, then we're in a consolidation. The market will go up later. If it's rolling over, then it's going to get really nasty, faster than people expect. Not immediately, but maybe in a month or two or whatever. Either way, we got to really be watching and on top of the situation and looking at all kinds of information to determine what's going on. Let me ask you about a different market. It's kind of funny. While everyone is bullish on gold, on the stock market, gold dipped during the drop. The gold stocks went back down. Now this week they've gone back up, and gold itself went through 1350. There's a big rally of over 20 points in gold yesterday. However, while everyone's bullish on the stock market, I can tell you nobody cares about gold. In the past week, I've gotten one single email on the free email list I got from a person about gold, and that person was telling me that it's going to crash, and he was citing Martin Armstrong's Socrates computer, and that's the only email I got. So no one cares about it. What do you think?
Well, I really like the setup in gold here, and it actually reminds me. When we first met, it was early 2002, and it was right at the start of the gold bull market of the 2000s. And actually, what's reminding me about gold right now, it's actually nothing's ever exactly the same, but it's amazing how similar it is. It really reminds me of the late 80s in that 2007 was the year that gold busted. Gold went from over $400 in 1996, busted in 2007 to under 300, then really spent most of the next 4 to 5 years, bottoming from 98 to 2002. And then finally in late 2002, it broke through this kind of 350 resistance level and then continued to go higher for essentially the rest of the decade until 2010, 2011. And to me, we've now seen kind of a similar scenario here where, we busted in 2013, which is similar to 1997. Gold kind of traded slowly lower into 99 after that bust. We trended slowly lower into 2015. We've got kind of this 4 or 5 year base going. And if we could break through about the 1375 to 1400 area, I think it's like breaking the 350 back in 2002. And I don't know if we'll start another, 9-year run, but I definitely think gold could start a 3, 4, 5, 6 year bull market because, the old saying goes, the longer the base, the more the space. So the longer that this basing continues in gold, and let's say gold bounces down off the resistance again, goes back down to 1330 or something in the short term, the longer that it continues to base under this 1375 to 1400 area, the bigger and longer the breakout is going to be. And you're right. That's really interesting about gold is that, for example, in 2016, Mike and I both found when gold broke through 1300 and 1350, there was a lot of interest in gold. People wanted to know which gold stocks I was trading or investing in the middle of 2016, all of this sort of thing. And now there's no interest. Now, maybe that's the combination of the stock market is now even a bigger bubble than 2016, even higher. You've got the advent of all these cryptocurrencies, which have gone, parabolic in the last couple of years, since that 2016 time period. So maybe it's because these other sectors have moved higher, so people aren't interested in gold. But it's really interesting that, you got gold on the cusp of this massive breakout potentially, and nobody cares.
Yeah, so we have a very interesting situation then with gold, as your chart suggests, where we go through those levels, and so we're at a critical junction there too this year, most likely. So there's lots of things going on that most people are either asleep on or are going to surprise people. Well, as we wrap up, do you have anything else you're looking at or want to point out, or at least tell people where to go to get more information from you?
Yeah. If you go to addictedtoprofits.net, I have a free email list. I'm actually going to start putting out more and more videos now because, as you mentioned earlier, I think we're at this kind of key junction right now where it looks like gold is completing this big multi-year base. You've probably got some kind of potential topping going on in the stock market, regardless if it's like this year is 2007 and it just takes the whole year to top out, or if it's like 29 or 87 and we're going to see a blow off in the summer, then and a big decline, or if we're in that Nikkei scenario. But either way, that would mean in the next few months, you want to look at stocks to short. You want to look at ways to hedge. I'm showing my investors ways to do this right now. I'm going to come out with 2 reports probably within the next few weeks. One being, the gold and precious metal stocks I like, and the other being like potential shorts, either via ETFs, options, or just straight out companies to look at short selling. So I think the next few months is very, very key to that. And a lot of times it just takes patience. Like, we were both bearish and say like in 2015 when the market dropped, but it was just a little early. And what we've done this time is, even though we were both very cautious, now we kind of waited for this first break in the market. And that's the thing about being patient. You wait for that first break in the market, then you wait for the ensuing rally. And if you were to get some of these shorts and say that was the top back in January, well, you're going to get in pretty close to the top of the equity markets. Even if there is a higher high coming, you're going to get in, I think, a relatively good position in the coming weeks. And as I mentioned, lots of stocks are not really acting that well on this rally. And to me, that's very key because actually that's something we didn't see in 2016 and 2017. We kind of saw everything go up and the internals were actually quite strong. So now that we're seeing stocks in certain sectors lagging, not acting well, I think that could be a sign that we're going to see kind of this top heavy move, where the FANG stocks, some big momentum stocks are leading the markets, but many other companies are not acting well.
Well, I'll just say real quickly, I looked the other day, what fell the most, what sectors fell the most, on this drop. It was energy stocks, home builder stocks, and retailers. So those are the areas of weakness that people probably have to be very careful if they're involved in them.
And what's interesting about the retailers and the home builders is those are two, we're talking about these rates going higher. Those are two sectors, either consumer spending or, home buying that would be really, really negatively effective if rates continue to go up on the long-term bond.
Well, thanks for taking the time to talk to me and everyone else, and we'll be doing more follow-ups as the situation unfolds.
Yeah. Thanks for having me.